What's going on, everybody? And welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade for yourself. Please like, please subscribe. Please make sure you hit that notification bell next to subscribe so you can get notified every single time that I drop an episode. Please note that I am not a financial advisor, nor am I a fiduciary, okay? I'm not an economist, nor do I manage money professionally. So please do your own research before investing into any stock and bonds for that matter. So, in this episode, we're going to talk about when stocks go down, what happens to bonds, okay? There is the conception out there in society that bonds are safer than stocks. And when stocks go down, typically bonds will perform pretty well and they will go up. In this episode, we're going to clear out some misconceptions and let us understand that, hey, we have to understand how we really need to buy bonds, and we need to actually understand the inverse relationship with bonds and how bonds move and how stocks move. Okay, so let's go to these charts and let's break down this relationship with when stocks go down, what happens to bonds. Let's start this off by looking at a chart. And the first chart that we're going to look at is we're going to look at the United States 10-year Treasury note. Okay, this is the 10-year Treasury note. And so what this means is that if you purchase this bond, okay, let's say that you purchased the 10-year Treasury note for the United States of America, okay? This bond has a particular yield or a coupon rate. And that coupon rate is a percentage of the money that you choose to invest that they will give you every single year, right? For 10 years, they will give you that exact same amount every single year for 10 years. At maturity, the maturity date or the end of that 10 years, they will give you your entire investment back. Okay, so pretty much right now, the 10-year note is almost at 3.5%. It's right there, y'all. It's right there. It's almost at 3.5%. And so let's say, for example, that the 10-year note was at 3.5%. And let's say you wanted to put $1,000 into that bond fund. Okay, you wanted to put $1,000 into the 10-year bond. What would happen is that you would give that $1,000 to the United States, and the United States would do whatever they wanted to do with that money for 10 years, right? And they would promise you 3.5% return every single year. So if you give $1,000, that 3.5% return would be $35. The United States would promise you $35 every single year. And then at the end of that 10 years, they will give you that $1,000 back. Now, in general, when we're talking about investing and when we're talking about safety, right? When you invest money into the United States bonds, right, that is considered a risk-free return. Okay, so what does that mean, a risk-free return? Pretty much when you invest money into the United States, that's pretty much saying, okay, I have faith that the United States government will pay me back, right? And for the most part, the United States has paid you back, right? If you invest the money into here, okay, there's a 99% chance that the United States government is going to pay you back. And so it's a risk-free return other than stocks. You know, stocks aren't necessarily going to pay you back necessarily depending on what you buy. And so we have to keep this in mind when we talk about the 10-year note. Now, let's answer this question, okay? When stocks go down, what happens to bonds? And so let's look at this chart again of the 10-year Treasury note. Now, this is a year-to-date chart of the 10-year Treasury note. Now, normally on this channel, we like looking at stocks, and we like looking at stocks and we're looking at charts. We want to see charts go up and to the right, okay? That's what we want to see. We want to see a performance, good performance. And when we see a chart going up and to the right, that normally means that we have some pretty good performance. And so right now I've got some levels marked off. The note was at 1.773% back in March. It was at 2.5% actually back in August of this year, which is crazy. and now it's all the way up to almost 3.5%. Now, like I said, we see it going up and to the right, and that is normally seen as a good thing. But when we're looking at bonds, this is a bad thing, okay? This is a bad thing in terms of returns to see the 10-year treasury note go up, right? The bonds have an inverse return. So as the yield of a bond as the yield of a bond fund goes up, that means that people are selling bonds, okay? People are selling bonds and the demand for the bonds are going down, okay? Remember, let me repeat that again. As the yield goes up, as you see the yield, the percentage yield for the bond goes up, that means that people are selling bonds and the demand is going down. When the yield is going down, that means that the demand for bonds is increasing, right? The demands for bonds are increasing, and that means that people are buying bonds. Now, this 3.44% yield that the 10-year is running at right now is a very, very good yield. And what you could do right now is that you could put your money into the 10-year yield and you could guarantee yourself 3.4% return for the next 10 years. That's a good thing for you if you buy the bond itself, right? If you buy the bond itself. But the problem is that a lot of times we invest into bond mutual funds and we invest into bond index funds. So the next chart we're going to look at is the bond ETF. Now, this is the Vanguard Total Bond Market ETF. And so pretty much how this bond market ETF works is that this ETF is constantly buying and selling bonds, okay? They're constantly buying and selling bonds. Bonds are constantly maturing in and out of the fund. So pretty much what you're getting is you're getting an average of all of the bonds. But remember what I said, as the yield goes up, that means that the return for bonds is going down. And this is a year-to-date chart of the total bond market ETF. As you can see, the return is going down. This bond fund has lost 13.61%. And I want to add a comparison to this chart. Let's add a chart of the S&P 500. The S&P 500 is in orange. This is a year-to-date chart of the S&P 500 and a year-to-date chart of the bonds. And as you can see, they're both moving down. They have both had bad performance. Currently, right now, the bond fund is down 13.38%, but the S&P 500 is down about 19.79%, so almost 20%. We're almost back into a bear market again. But let's look at this. Let's look at this chart. Let's look at what this is really truly telling us. Nevertheless, they're both going down, okay? Nevertheless, they're both negative. At brief moments back in March, the bond funds were actually performing worse than the S&P 500 was for a month, for a period of time, okay? So when stocks go down, it does not necessarily mean that bonds are not going down either, okay? Because the bond funds is going down as well. The only way that you can pretty much really get that risk-free return, to really truly get that risk-free return that people say you can get, is by buying a bond. When you buy a actual bond with a fixed coupon rate, that coupon rate is not fluctuating up and down. When you buy a bond market ETF, you are now putting yourself into position and having the risk of the fluctuation with the bonds. Now, let me tell you this, when people want to go back into bonds again, which will happen eventually, you will be able to get a good return based on how the bond market ETFs work. But just because stocks go down doesn't mean bonds are going to save you. Okay, this really, I believe, is the worst. I believe this is the worst record on year for the 60-40 portfolio. And the 60-40 portfolio means that you have a 60% mix of stocks and a 40% mix of bonds. But with this particular portfolio, you are getting beat to sleep in both directions, okay? That's why I want to really truly like explain this to you, right? And really understand how bonds move. Now, this is one thing I want to think about as well when we're looking at this chart. Okay, we're looking at the year-to-date chart. We know the stock market has had the worst first half since 2020, or we had the worst first half this year. Okay, we had the worst first half in 2022 since 1970, right? We also understand that bonds have been performing negatively as well. Okay, so when stocks are down, okay, and then we also see that bonds are down, okay, what is up? Okay, so when stocks are down and when bonds are down, there's one piece of paper, okay, there's one piece of paper that is getting some very, very good demand and is having very, very good performance, and that is the dollar. Okay, that is the United States dollar. Okay, if you look at this, is a year-to-date chart of the United States dollar. And when we look at the United States dollar has had a 14.74% return year to date. That's very, very good. But that makes sense too, though, because I want you to remember this. The money has to go somewhere, right? Money is always moving around. Money's always moving around in the stock market. Money's always moving around in the bond market. The dollar's moving around. And when you see these charts move up and down and fluctuate, these are visual representations of money working. And what I will always tell you is that your money has to be working harder for you than you are working for it. And what I want to tell you is that we see that the dollar has been performing very, very well. And so what has been happening is that people don't like stocks and people don't like bonds. So they're going into the United States dollar because they see the dollar as safety. And what they want to do is they want to have that fixed income, right? They want to be in the dollar. They want to have that fixed income and they want to wait it out. They want to wait it out until they have more faith in the economy. When stocks go down and when bonds go down, that is an indication that investors do not have faith in the economy. Okay. Eventually, I want to tell y'all that I believe the economy is going to turn around, but that's just how the fluctuation of the money and the currencies work. Now, this is another thing I want to put on here too. I want to put on another comparison. Let's add a comparison of the euro. Okay. Let's add a comparison of the euro. Okay, so we see that the dollar has had a very good performance year to date, but the euro has been going in the opposite direction. The dollar's up 14.74%, but the euro is down 11.43%. And so why is that? Right now, everybody believes, and actually Europe is going through a recession. Europe is going through a recession because of the increase in cost in terms of energy, the energy cost related to the Russia and Ukraine invasion. And so Europe is not the only currency that hasn't been performing well. The Japanese yen has not been performing well, and other currencies, other international currencies have not been performing well, and the dollar has been performing very, very well. And so, like I said before, when you see this happen, when you see the dollar performing very, very well, the dollar has had one of its best years on record, and really one of the best years it's had really in the last 20 to 25 years. And so when you see that, that lets you know how investors are feeling about putting their money to work for a fixed period of time, okay? Putting their money into stocks, putting their money into bonds, right? They want to have their money. They really, truly want to have that safety and that security for now until they feel that it's appropriate to go back into bonds or to go back into stocks. So as we close out, when stocks go down, what happens to bonds? It just depends. It depends on what's going on in the economy. It's dependent upon what's going on with inflation, the global economy, okay? Certain currencies, right? Remember, we talked about the dollar being up, right? But the euro being down, the Japanese yen being down, right? Stocks are performing badly, bonds are performing badly, so the dollar is going up. That's because investors don't really have good faith in the U.S. economy right now. So they would decide that they want to go into fixed income, right? They want to go into fixed income and they want to be into the dollar until they feel good enough about how the economy is performing. But remember this, just because you buy a bond fund, that's not going to save you. Buying a bond fund is not going to save you because of the fluctuation. because of them buying and selling bonds and certain bonds maturing at certain times and them adding bonds other times. That's not going to save you. The only way to really truly get that risk-free return, get that risk-free guaranteed return, is to buy you a U.S. Treasury note. Actually buy one, not a bond fund. Actually buy the note. Whether it's the 3-month note, whether it's the 2-year note, 5-year, 10-year note. Buy that note to get that fixed rate of return. That fixed rate of return is going to protect your money and give you that return on your money, okay? Just remember that. That's the only way to get that real deal risk-free return. As always, I appreciate y'all for tapping in with another episode of the Trade for Yourself podcast, right? Please like, please subscribe. Like I said, hit that notification bell next to subscribe so you can be in the know every time I drop an episode. Look, y'all, the channel and the podcast is only growing. Look, please reach out to me in the comments. Let me know what you think about stocks. Let me know what you think about bonds. Let me know how you feel about the 60-40 portfolio. Whatever you want to do related to stocks and related to bonds, please reach out to me in the comments and let me know how you feel. As always, y'all, don't pay for it. Trade for it. I'm going to catch up with y'all next time.